I felt so afraid to approach them with this first monthly loss, which was only 3%.
Welcome back, investor, to another episode of the Passive Income Adventures, where we share stories from investors just like you who are creating a life of passive income and freedom to do what they want, when they want, with who they want, where they want. Isn't that the dream for all of us? And the biggest thing that we need to do to get this to happen is to be able to invest enough money that we're generating enough passive income so that we can live on that passive income. And I've got James Brandolino here today to tell you that it's not about how much money you make, it's about how much money you keep. He's the investment fraud guy, and he is sharing the message about how to protect your assets from fraudsters. And this is a thing that most people don't want to talk about. I've had several run ins and experiences with times where we were approached to participate in some sort of an investment thing that ended up being a scheme, and people went to prison, and for whatever reason we were always able to avoid having that happen to us. But because it happened so many times that where we were considering or had the opportunity, or friends of ours that committed these crimes then ended up not the people that we thought they were, going from a normal guy to somebody who's in prison for stealing, in some cases, tens of millions of dollars, and how we became hyper aware of being able to protect ourselves from those types of things that are happening in any kind of an industry where there's a lot of money at stake, especially given the recent FTX verdict. And the awareness that these types of things are going on makes a lot of investors too scared to actually make decisions. And so I want this conversation to be out in the open and transparent, because if you don't know what the red flags are, or how to protect yourself, or how to recognize if the person that you're investing with is one of the good guys, then it creates a sense of fear and prevents people from being able to take action. Now, we all know that every investment has a risk of not going well, whether it's due to market conditions out of our control, whether it's due to incompetence of the manager, or whether it's due to something that starts to come apart and they end up committing some sort of fraud or crime in order to buy them time to try and fix it and turn it around, and hoping nobody ever finds out what they did, which I'm sure that happens as well, where nobody ever does find out and they're able to turn it around and everybody thinks they're a hero. But at the same time, learning those red flags will help to empower you to be able to make more confident investing decisions. And that's what James is all about. He's really dedicated to helping investors and high net worth individuals who often find themselves targets of these frauds to be able to recognize them and take the steps that they need to do the proper due diligence to protect themselves. So give a listen to James. Take a lot of notes. It's a long episode and we could have kept going. There's so much in here. One thing I just want to reiterate is don't feel overwhelmed. Come away from it feeling empowered, and reach out to James if you have any questions about any investments that you're considering, or that you maybe are a little suspicious of if they're starting to go the wrong direction. So enjoy James Brandolino. Welcome back, investor. We're live with James Brandolino. I have been waiting for this interview for a really long time. I think we've been playing like rescheduling tag. So super happy to have you on today. Why don't you take a second and introduce yourself, kind of tell us your story and how you got to where you are today as the investment fraud guy.
I am an investment fraud prevention expert, and I help investors safeguard in their assets from fraudsters. Interestingly, most investment fraud does not begin as investment fraud. Probably 10-15% of investment fraud cases begin where someone wakes up in the morning and wants to steal 5, 10, 15, 20, $100 million from investors, and goes out and opens a bank account and puts up a website and goes and solicits money. And as soon as that knock on the front door occurs from the FBI, they're out the back door and on a plane to Brazil or wherever they're going to go. Most investment fraud begins with honest people who make a mistake or have a problem in their business. In terms of, in my case, I had trading losses that I did not expect. And in terms of real estate, maybe interest rates go higher, maybe property values go lower, and people will do whatever they need to do to buy time. And in terms of buying time, that means fudging financial statements. So allowing people to believe that everything is fine in order for the market to come back, or in my case, that trading would turn back profitable. In my particular case, I was a trader at the Chicago Board of Trade. I had traded for many years before that, quite successfully. And in 1999, I left working as an ops manager at a major firm in Chicago and basically started trading investor money. And very, very early on, I started losing money. And most of my investors were family, friends, and former retail clients. And I felt so afraid to approach them with this first monthly loss, which was only 3%, mind you. I felt that they were going to pull their funds out and that my career would end just as quickly as it began. And I would never be able to go to my family and friends again once I was able to turn things around. And then what was I going to do? Where was my career going to go? So basically, what I did, I fudged the first month's statements thinking that, okay, -3%, I could make that back in a month, 6 weeks, 2 months. And unfortunately, that didn't happen. -3%, -4%, -5%, -10%, -20%. And I never turned profitable. So this went on, me fudging statements and fudging audits for about 18 months, for about a year and a half. And it came to the point where I needed to raise more money because I was losing money and I needed a certain amount of money to trade futures, which I was trading on the trading floor. So what happened was instead of going out and raising money from new investors, I basically put my net worth into the fund, right? I rated my 401k. I got a home equity line of credit on my condo and basically put my life savings into the fund. And that lasted probably another almost year and a half. So now we're about 3 years out and I haven't stolen any money, right? I've just fudged statements. So my investors were thinking that they're they're making 1 to 2% a month. And in actuality, they were probably down about 80%. But I had not stolen money. That's how I rationalized. I just need more time to figure this out. So what happened was at that 3 year mark, it came to the point where I was basically financially tapped. And I had a client refer me to one of his big business owner friends who wrote a huge check. And at that point, that's when I started to take money, embezzle money for my personal expenses and for business expenses, thinking that I could make the money back. And that went on from year 3 to year 8. And basically, during that time, I had hired quantitative analysts. I spent hundreds of thousands of dollars of both my money and client money trying to get the math of my models to work. I brought on other traders from the floor that I knew, paying them to try to get them to come up with different trading patterns that I could trade off of that unfortunately never worked. I even went to a trading psychiatrist who works with emotions and with trading, and nothing worked. So basically, the at the almost the 8 year mark, I wake up one morning and decide I'm never going to make the money back. I'm down about almost $4 million. I'm not going to make it back. If I haven't made it back in 8 years, I'm not going to make it back. And after a period of what I would call just very high emotional stress, I walked into the U.S. Attorney's office with my attorney. And in front of the FBI and U.S. Attorney, I basically said, "This is who I am. This is what I did. Here's all my paperwork, and indict me." And I served 6.5 years in federal prison. I pled guilty to one count of mail fraud, sending fictitious financial statements in the mail. And I've been out for about 5 years, and I basically work with law enforcement on investment fraud cases. I work with private clients, coaching and consulting with organizations who deal with private investments, and I go in and do the due diligence and ensure that, to the best of my knowledge and ability, that they are not dealing with a potential fraudster.
There's a lot.
It's a lot, isn't it?
Yeah, I'm feeling we've had a lot of experiences in our lives where friends of ours, people that we knew, people I grew up with their kids, or people I've met through my investing who have committed fraud and gone to prison. And to watch the process that they go through and what their families go through and the mental gymnastics of moral justifications that they need to go through to convince themselves that what they're doing is okay. I think one thing that's unique about your story versus most of the people I know who've been through this is that your transparency and lack of attempt to gloss over it is unique because most people, even after they're in prison, refuse to admit they did anything wrong, refuse to admit that they moved investor money from one project to another, or they brought in new investors to cover the withdrawals of the first investors. And you've been very clear that those types of attempts to say, oh, this or that, I followed my attorney's advice, or I followed my accountant's advice, or we had investments that went wrong, and I'm very sorry for people who lost money, but I did the best that I could to protect my investor money, and will not admit to the fraud. Or if they admit to the fraud, try and make it sound like they didn't really know that it was wrong and certainly didn't know it was illegal. And one thing that really sticks into my head was when I was talking to somebody, he got out in front of the fact that he was in prison and really made sure you don't want that to come up on a background check when you are looking for doing projects with people. So he got right out in front of that. So I asked him to tell me more about it. And he said one thing that really set off my red flags. He said, basically was taking from one project that was doing well to save another project that was sinking. And he said, I knew it was wrong. I just didn't know it was illegal. And I thought, oh, okay, that's all I needed to hear, right? If you're going to do something that you knew was wrong, it doesn't have to be illegal. And so, can you guide us through the process of what investors need to know if they are? There's two different questions here. If they're sinking into what is a Ponzi scheme, but they don't know it yet because everything looks fine, financial statements look fine, they're getting withdrawals are fine. What are the first red flags that they be like, hey, I think that I have my money in a bad situation? Or if they're going to trust somebody who's come out of that and during their reformation process, what kinds of things should that operator be saying to let us know, like, he really did learn his lesson, that he's not trying to hide behind these moral gymnastics?
Wow, that's a handful.
Yeah.
I'm gonna start with the second question first. So in terms of dealing with someone who has a background, whether it's a misdemeanor or a felony, financial felony, I would look at them if I'm going in and I'm doing a due diligence exam either before somebody's invested or if they've invested in going in and looking at the books and everything. It doesn't matter to me whether I'm not profiling. And I'll give you an example, whether somebody has a background and has been to prison or whether there's somebody that's 25 years old or whether somebody is 60 years old, whether they're a very good salesperson or whether they're quiet and introverted, no matter what those characteristics, those behavior and personality characteristics are, whether they went to Harvard or whether they went to junior college, it really doesn't matter because history has taught us that there is no one profile for Ponzi schemers, for bad actors. So it doesn't really matter if they've got a background or not. And really, in terms of Ponzi schemes and investment fraud, it's a little bit easier to investigate because we already have a starting point, right? We know who is at the top of the chain. We know who the head trader is or who the CEO is or who the management team is. Everything's listed in the PPM. And we just need to start doing our diligence in terms of making sure they are who they say they are. But something that's much more difficult, easier said than done, is making sure that they're doing what they say they're doing in their PPM. And that's probably the hardest thing. Most people who contact me, I would say, have already invested, unfortunately. And they want me to go in and do perform due diligence, and they don't want to let the firm know, or the person who's at the top of the chain doesn't want them to know that I'm investigating them. And that's a little bit difficult because I've got this PPM and I need to go through the back door and try to find out what they're doing. And it's very difficult. Where typically, if somebody has not invested yet, I can usually call the lead principal, right, the managing partner, and say, "Hey, this is I'm so and I need to do a due diligence exam." And 9.5 times out of 10, they're going to say, "Yeah, let's come on in or fly in or whatever. Let's have a conversation and ask whatever you want." And there's no problem. But in terms of making sure that the person is who they say they are is easy, but are they doing what they're supposed to be doing? And whether a fund is fraudulent or whether it's not, usually the PPMs are legal, right? Because if someone who starts the process as an honest person, like I did my PPM, I spent probably 15 grand back in the late 90s to have my PPM done, and it was fine. I just didn't do what I said I should be doing
Mhm.
according to that document. And someone who completely out there to steal investor money, basically they're going to lift something that from another website. They're going to go to a very successful private equity firm or a hedge fund or other PPM out there, and they're basically going to lift that document and they're just going to change the words, redot the I's and cross the T's, and they're going to make it their own. So it quote unquote is a legal document. It's not their legal document, but it
Mhm.
looks really good. The problem is is that investors have to know how to go through and verify if what they say they're doing, that they're doing.
So, what do you do in that case? Was one of the things that we really want to teach our investors is how to read the legal disclosures. It can be
Sure.
boring, people don't love it, and they're just going through and checking through it as best they can. What are they looking for in that document to let them know, one, even though it's rare, somebody has fraudulent PPM and they are out to scam you from the get-go? Because like you said, most PPMs are prepared by a lawyer, they're done in good faith, and then the people are departing from that. So let's start out with the first thing that you mentioned. It's just a fraudulent PPM that they got from some website and they send it to you. How do you verify that was created in by an attorney that's actually represents that person?
Okay, well, it's a little bit easier now with AI and with Grammarly, but I
Mm,
use a product that's a little bit more in depth. And basically, I basically upload that PPM into my software and I run it through and I see if anything's been plagiarized. And to have a couple lines here and a couple lines, you're talking a 20, 30 page document. Yeah,
yeah.
there's going to be verbiage that's the same. But when you're looking at multiple paragraphs that are basically word for word, you're going to know that they probably lifted it someplace.
Hmm.
There's been a few situations where an attorney has gone in and basically, especially on the disclosure part, because a lot of that's is rote. A lot of it's the
Yeah, I love
same.
boilerplate stuff.
Exactly correct. But in terms of looking at the first part of it, what they do, how they do it, what makes them different, competitive advantage, and all that stuff. A lot of times they'll be lifting that from
Mm.
Blackstone, from whatever company that they're taking it from, and it's very easy to find out if somebody has not a professional's not written that form. Sure.
Okay, and then how about the second case where the documents are all in order? The original intent was not to commit fraud, but things start to go bad and the project needs to be saved basically. And that's probably in my experience that's been the most common time when a project starts to go downhill and then they start moving things around or putting up fraudulent collateral to secure more loans. Things like that is what I see. So what are investors looking for? How do they know that's starting to happen? And is it too late at that point because they've already invested and they're limited partners they can't liquidate?
So I would say the place where you're going to find that is in the financials
Okay.
and in the audits. As you know, Emma, the SEC back on October of August 23rd of this year of
Mhm.
2023 basically has come out with some new rules and regs. And I know this is being contested right now in court, but the SEC is looking for private fund advisors to provide investors with quarterly statements, right? Detailing fees, expenses, and performance, and also to distribute an annual audit to investors with a fairness of opinion. In terms of the real estate world, that is a pretty tough cookie, right? Because real estate values, if you have five accountants and you're going to get six different opinions
Yeah.
on where that valuation should be, but that's their job, that's what they do. So I'd like to talk about audits because audits is something that I'm an expert at because I faked audits for probably 7 out of the 8 years. And basically, what I did when my clients called up and said, "Hey, do you have audited statements?" And I said, "Yeah, sure. Give me a week when I get back into town and I'll get them to you." And what did I do? I went on Google hedge fund audit and I found two or three of them, one on Excel, and created one. And not only did I create the audit, I created the a fake website for the audit firm based in New York. Now, number one, no one had ever called because I had a virtual address in New York for this firm. No one ever called or emailed it looking to talk to somebody
Wow.
or verified that it was actually a real audit. On my audited financials, we're not going to do it today, but in my presentations, I show the audited financials that I used, and on multiple years, there are mistakes that an auditor would never make. I,
Mm.
mix and match numbers, and just a ton of red flags just in that process. But in terms of looking at that audits for hedge funds or private equity or multifamily PPMs or whatever, they're really straightforward, right? Because you're really looking for three things. Do the assets exist? Are the performance returns real? And
Mhm.
how are the assets custodied? I'm not sure if that's a real word, custodied.
It is
Who is
now.
holding the assets? Are they being held in the name of the fund or are they somewhere else? And it's really looking to see those. correctly. And a lot of times we really can't see if the performance returns are real. I'm looking probably at first just to look and see if the assets are they there? Is cash there? Is escrow there? How is everything registered? And for an individual investor, sometimes it's a little bit tough. If there's just one or two buildings, it's one thing. But if there's a portfolio, it can get a little bit, it can get a little bit difficult to go and do that. But you got a couple issues here. Number one, if a fraudster hands over an audit, and it could be a completely fake audit, and it will say, let's just say ABC accounting firm on it, right? There is a big problem with that. Number one, did ABC accounting firm actually do the audit, right? So you have to call the auditing firm or write to them, and a lot of times they won't even confirm if they're the client, right? If they actually were engaged to do the audit, number one. Number two, maybe they did the audit, but the fraudster is changing a couple numbers here and a couple numbers there, or maybe on the financial sheet, does his own Excel sheet and slips it in. And so the ABC accounting firm actually did the audit, but not exactly what they're giving out to clients. And basically what I always recommend is that if there's an audit, you go right to the source and you ask, I I want a copy of the audit to make sure that I'm getting the right one. And some firms will say no, won't do it. I've had a call a couple times and say who I am and what I'm doing. And look, if you want a problem here, if this thing blows up, you probably better look at the numbers now and let me show you what he's giving out and let me see what you actually did for the client. So a lot of times, yeah, a lot of times it's very difficult to even confirm that the audit that the fraudster is giving out was actually performed.
Mhm.
So
So,
that's
this is it's almost overwhelming to me, and I'm an operator, like, I'm a fund manager. I
sure.
have my face in spreadsheets all day long, and to think, "Okay, what is the process that I would need to go through as a Main Street investor to be able to verify that what I'm getting is accurate is a little overwhelming. So how can you direct the Main Street investor to the things that they need to be able to do? Because if most people would request audited financials, they would get a spreadsheet, they would open it, not read it because they don't know how, and feel a little overwhelmed to be like, oh, it's good enough. Or they might request it from the original firm and get it if they'll release it, open it, look at it, be like, looks like a reputable firm, and not read it. And so, what are they looking for in the reports themselves from somebody who's not used to reading these things?
So the easy answer is that basically you're line checking every item to make sure that it's accurate, that it's real. Is That's the easy answer. In reality, that can be very difficult, if not impossible. But really, you're verifying that the assets are there. You're verifying that the debt is real. Your whatever mortgages or liens are on the property are there. You're checking how those they are registered, who is holding those. Are they in a trust? Are they in the fund name? How are they? Who has access to move money in and out of bank accounts? Are there more than one bank account? Is a CPA firm not so much auditing, but is there an overview that they're looking at to see what money is going in and out of the fund? What is there a third party administrator that's watching over everything, or a CPA firm that's watching over everything? Or are they just coming in once a year to do an audit, if that? In terms of the numbers, we could spend 3 hours going over what ratios should be and what numbers should look like. And there are sometimes you can look at a financial statement and within probably 30 seconds say, this is not, something's not quite right. And other times, boy, it's really difficult to really see what the truth is. But you probably should go to a third party, either a fraud examiner or go to another CP, a forensic accountant, and have them look at the numbers and say, and run it through and see what it looks like. Because it's just really difficult to tell if there's fraud going on from a financial statement. But that's the first place that I would look.
What's the difference between due diligence before investing and due diligence on when you suspect that there's been some sort of behavior or some sort of fraud that's starting to occur? Like you're victim number one, basically. Because the process that you're going to go through just in your run of the mill due diligence before you invest is going to look different than a forensic analysis if you suspect a wrongdoing. Or
Okay.
would it?
So, yes. No, that's a great question. So, the top two reasons that investors lose money to investment fraud and or Ponzi schemes are: number two, they don't perform proper due diligence.
Hmm.
Number one, they don't perform proper due diligence on a periodic basis.
Okay.
And understand that most investment fraud is based on fear, not greed. So if it's greed, the financial statements and fraud are going to be occurring on day one.
Hmm.
But if it's an honest person that gets into trouble, you never know when that fraud is going to begin. So from day one, two, or month one, two, three, four, 5, 10, 12, the first year, everything might be fine. And then something happens, right? A catalyst occurs
Mm.
and they start fudging documents. And if you're not performing a certain level of due diligence every 6 months or every year, you're going to miss that. And
Hmm.
that's why it's so important, because with most investment fraud, since it's based on fear, you never know when it's gonna pop up. So you have to be looking at a periodic timetable of when you're gonna go in and you're gonna re-audit the books and ask the right questions and get all the questions answered.
Is there something that an investor, especially a limited partner, can do if they start to suspect something is going poorly? Because sometimes it's just lack of communication from the operator, and so that's a red flag. I don't know what's going on, and so are they trying to cover up that that's where our minds start going when we're not getting regular communications? But if they're sending out the financials and all of that, and we're looking at it, we're like, something just doesn't seem right. Again, it's not liquid. Is there anything that somebody can do at that point to call? I've reported somebody to the SEC before, and they called me pretty quickly and did a fairly in-depth interview asking what I saw and what I needed. And would that be the way to go? Or what kind of recourse is there in those early stages of suspicion?
So I would say that probably the one of the questions I'm asked most after one of my presentations, people coming
Mhm.
up are, I invested in this fund and everything's fine, everything's great. I'm making money and I'm really happy with it. But the statements are coming a little bit later than they normally do. When I call to ask a question, it takes them 4 or 5 days to get back to me. Sometimes I've got to call 2 or 3 times. And I'm not worried or anything, but I want you to go in
Would I
and
be?
start poking around and start doing things. And it's not so much that it's too late, although a lot of private equity and hedge funds are not very liquid, right? And the chance of even wanting to withdraw your money, there's probably not enough cash so much to do
Yeah.
that. A couple things. So if somebody calls me and I go in and I do a half an hour review of what's there, and if I think that there's a problem, the first thing that we do is we hook up with an attorney,
Mhm.
because they absolutely need an attorney. That way, anything that I find, I have attorney client privilege with their attorney. There's the three of us. That's the first thing. Going to the SEC, that's great. I haven't had the I'm not gonna say I haven't had the best luck with going directly to the SEC. I work with law enforcement. I would probably would go to law enforcement
Mhm.
at the highest levels, let's just say, before I would go to the SEC, because they would have a better a direct ear to the SEC, and they can go in and do the investigation. Where the SEC, who knows how long it may take to do it. I would say, yeah, either find a fraud examiner to help you out, go to an attorney who has a fraud examiner that they can call on to look at it, or I guess I would go to the SEC as well, and it just would depend on how fast they would move on it.
Mm. Yeah, I think in my case, the reason I went that route is because when I was doing some due diligence, when things started to look a little bit fishy, found some lawsuits that were pending. And
Right,
so it looked like he was already on their radar. And so I reached out.
right.
I just wanted to add my voice to say, hey, it's still going on. And I don't know what happened in that case. They never followed up with me. So it'd be interesting to go and research that again and see what happened there. But I just felt like
Right.
they were already onto him, and I just wanted to make sure that I added to that body of evidence with my experience dealing with him.
Yeah, you have to reach out. You have to reach out to an expert. In going to an attorney or CPA, there are benefits to doing so, and also make sure that you go to an attorney and or a CPA to look at those numbers, who's experienced with hedge funds and private equity and PPMs. And I give a little anecdote at my presentations. My fraud lasted literally 8 years to the day, and the 95% of my investors were high net worth, sophisticated investors, business owners. Some performed their due diligence the do-it-yourself way, which
Mhm.
they asked a lot of good questions. They did a lot of the right things. Some of them had their CPAs and attorneys grill me and look at all my stuff. And we're talking big firms, their offices dot the Chicago skyline. And what was the result of all their efforts? My fraud lasted for 8 years, right?
Yeah.
Meaning if a CPA or a trust officer or an attorney doesn't have experience or doesn't know what to look for, they're not going to find it. And I can't tell you over 8 years how many phone calls and lunches and in-person dinners that I had with CPAs and attorneys and clients, and nobody ever found out my fraud.
And I
And
think
it really it's when I was incarcerated, I went through a period and I can't believe these guys couldn't figure it out. If they would have figured it out after a year or two, before I actually started taking money, yeah, I would have lost my license. Yeah, I would have been kicked off the trading floor. There would have been some civil suits, and I never would
Mhm.
have went to prison, etc. And that was the wrong attitude to have. But I just couldn't understand how they could miss so many red flags. And when I was incarcerated, I had my sister who's a librarian. She sent me a hundreds of federal and state cases that I went over. I had the opportunity to really interview and grill dozens of other financial fraudsters, and basically came up with an algorithm that I use today in my consulting practice that looked at about 100 red flags that are there in varying numbers depending upon the product used and the intention and motivation of the fraudster. But
So
it's
one of
off.
the reasons I wanna talk about this issue, because when I bring it up, when somebody wants to have me on a podcast or have me speak at their Zoom meeting, and I wanna share my story of the fraud that I've encountered and that I've either been victim of or narrowly escaped or was invited to be a victim of, they don't wanna talk about it. They say that it scares investors and it's negative, and I feel like, knowledge is power, and how can because what you're saying, missing all these things, 100 red flags, digging into the financials, how can this be an empowering conversation for investors to feel like I can confidently invest knowing that a well-intentioned person can go into left field when things start to go bad and they get afraid? It almost seems overwhelming. And so, how can we feel confident to invest in anything if we're not an expert, even if our CPAs aren't able to find it?
It's bottom line, it's performing proper due diligence, right? Looking
Mhm,
at the investment itself, looking at the principals and employees, looking at the investment firm, and looking at, and number four, looking at the primary service providers that are dealing with that. And it's basically doing a pretty in-depth analysis and exam of are they who they say they are, and are they doing what they say they're doing? And
mhm,
that's really what it comes down to. Much easier said than done. I think a lot of people, first of all, to answer your question, talking investment fraud and Ponzi schemes is not a sexy subject, right?
mm,
The only time you see it on CNBC or on major TV is when a scam comes out. I remember when the Bernie Madoff thing came out, and I was 8 year or 6 years into my fraud, and thinking, oh my God, this is it. This stuff is coming out, and now my clients are going to start asking some better questions, and it's going to within a month, 2 3 months, I'm going to be found out. No, never. Didn't happen.
mm.
And it's just people don't know what to do, or they don't know how to do it, and or they think that others have done it. A lot of investment fraud is word of mouth, and there's a lot of, it's called affinity fraud, and affinity fraud is not really a fraud. Affinity is a type of marketing where you introduce your friends, your
Mhm,
church members, your business associates, and hey, I got this investment, and you should take a look at it, and maybe they're getting a slice of the commission, or maybe they're getting some type of benefit from it, and it increases it breaks down those barriers because you're getting the fraudsters getting a referral, and referrals are so much easier
mhm,
to close. But I think the biggest problem is, and this comes from the SEC, this comes from the media, this comes from law enforcement. They try to profile. Of course, the big one is if it looks too good to be true, it must be. If anybody invested in Uber or Amazon or any of the big ones, I'm sure they looked too good to be true
good to be
too.
true.
What does that mean? And basically, it's breaking it down in terms of what does that mean? What numbers are too good to be true? But a lot of what we hear from the SEC and law enforcement talk about the personality traits of of the fraudster, which are completely irrelevant. If he's trying to close you right away, then he wants you to send money today, don't invest. Like example, Madoff, myself, very introverted. We're like, hey, this is what it is. If you want to invest, great. Give me a call. I'll see you later. The personality doesn't matter. If someone is a used car salesman trying to hawk an investment, or is just the most mild mannered, quiet person, it doesn't matter. It doesn't matter what it is. You have to go in with the same diligence, no matter if you know the person, if you don't know the person, if the person is an esteemed colleague of a friend, if he's been in the business for 25 years, if he's a graduate of Harvard and starting a fund, it doesn't matter. You do the same
Yeah.
work regardless of who it is.
Yeah. And I think you being able to pull this off for 8 years and with the referrals, 8 years is a decent chunk of time to have a good reputation to be getting referrals. And so even the power of the referral, and I think that's the danger of the Ponzi scheme is because people who've referred me to Ponzi schemes, they were getting their money back. They were being paid back. And so they were seeing the proof that this cash was coming back to them. And they were saying, oh, if I had more to invest, I'd invest more. And I think that usually I took that, it's too good to be true. I'm not going to invest. But I think more of it was is I didn't quite understand what they were investing in. And that's why I opted out because it was like, oh, we buy some businesses and we do some stuff. And it just seemed very vague. But with multifamily, especially with a single offering syndication, exactly the property, you see the address,
Sure.
you understand very well what's being invested, and we're going to fix this place up and then we're gonna go and rent it out for more than it's renting out now. It's a very clear kind of rinse and repeat, almost boring business plan tied to a specific asset. And I think what we're gonna start seeing right now as interest rates are going up and rate caps are expiring and things are starting to go in trouble, and it's the foreclosure event that, or the short sale or the fire sale event that everybody's been waiting for. And are we going to see an uptick in investigations from limited partners who have basically lost their entire investment to something that was foreclosed, and they're like, "Hey, I lost my entire investment and I want this looked at to see if there was fraud here." How does that affect the real estate private equity world as we're going through this evaluation adjustment that we're experiencing right now?
So, how I look at it in terms of whether it's private equity or hedge fund or real estate or crypto or whatever it may be, there's certain standard operating procedures that a top notch firm would follow from A to Z. And I think that investors would need to know, are they doing steps A through Z if they were completely honest and legitimate? And
Mhm.
that's if they are, or and more so if they're not, what does that mean? Is it a civil violation? Is it a criminal violation? Now, I'll give you an example. I just finished investigating a PPM group that when they bought a second or third property, and there was a lien, a tax lien that the county would not relinquish, and they
Mhm.
did not let the investors know, but they wanted actually the property was a great property, and there's a ton of potential, but the real estate tax lien was probably for about 150 or so thousand dollars. So it was
Right.
a material amount in terms of what they paid for the property. And I think that if they would have been honest with their investors, hey, we're going to take smaller returns for the first 5 years because we want to pay this off, but this is a great opportunity. Yeah, they may have lost a few. Maybe they would have had to go out and put some more money themselves or find new investors. But if they would have done that the right way, they wouldn't have the problems. Of course, they ended up foreclosing because they had to pay the lien off and they had drained all their cash and et cetera, et cetera. And now it's not civil. Now there's felony charges involved, and the Department of Justice has got involved. I think that if, in terms of the industry, the majority of firms and people that are out there are doing the right things. They're honest people doing the right things. Yeah, I think that there's an influx of people who are raising capital who maybe have 20 or 30 units and they think they're the next real estate mogul, and they go in they want to start raising money, and they make mistakes, not because they want to, but just because they're inexperienced and there's
Mhm.
no malice involved in it. And I wouldn't necessarily steer anybody away from that, but it's really difficult to see a lot of the mistakes that, or decisions that some of these groups are making and trying to get them past investors. And I would think that most real estate professionals and firms would want that transparency. I would think they would want to. Most are not hiding things. But the problem is you just never know which ones are. You never know who it is. And that's why I say if it's your neighbor, if it's your neighbor's son, if whoever the person is that's soliciting funds, whether it's a friend, whether it's somebody from church, whether it's your business associate, and whatever kind of experience level and expertise that the principals of the organization have, you have to go in and do your due diligence because you
Mhm.
just never know who it is that is potentially going to commit fraud.
Yeah, and I had an exchange recently with, a tech startup founder that we're friends with, and I'm invested in, some of his startups. And I was saying how impressed I was because he raises money legally. He knows what accredited investors are. He knows his 506(b)(c) status. He files his Form Ds. And I mentioned how unusual that actually is, especially the tech startup space. I feel like it's a little better in the real estate space, especially the larger properties are doing a better job of making sure they're raising money legally. And he told me that he was shaken up pretty badly by a friend of ours who went to prison for a Ponzi scheme, basically. And when that sentence came down, he sat back and he said, "Wait, you can go to jail for raising money illegally or for moving funds illegally or for misappropriating funds?" And this was before he was raising any money. And he sat back and he said, "Wow," because he was thinking of doing his tech startup. And he said, "I really need to learn about this process because our friend just went to prison for a very long time for this 5-year fraud where he stole tens of millions of dollars." And it really helped him to keep his own nose clean because even though he was planning on raising capital, he at the time didn't have any idea how to do it. So as he approaches investors, somebody like me, I was like, this looks clean, good job. But most people are not going to know. So, what are some of the early warning signs that somebody is raising money illegally due to maybe just ignorance and incompetence?
Probably the first question that I would ask someone if they were to call me, I would ask, "How were you solicited?
Mhm.
Were you called? Was it a friend of a friend? How and how at what point did you actually speak to a salesperson or principal at the firm?" And then I would ask, "Were you asked if you are a accredited investor or not?" And in a lot of cases, they are not. Most Regulation D or exempt securities are either a 506B or a 506C. A 506B, you can have up to 35 non accredited investors. And a lot of times people are not asked. I've gone in and I've seen just the opposite too. I've seen where there was two forms that the person had to sign, that the client had to sign, that they needed an actual statement from their CPA or bank stating, verifying that yes, this person does meet accredited status. And basically it had numbered PPM forms, booklets, and basically put the number on a separate spreadsheet of which one they got. You can get really detailed on this. That was probably just a little bit much. You as an operator, you've got to protect yourself. But in terms of investors, if you're not being asked within the first 60 to 60 seconds of your accredited status,
Mm,
if you are or if you're not, that's a huge red flag. Number one. Number two, you're going to ask them what type of offering is it, and like I said, probably 95% or so are the 506B and 506C offerings. And what you're going to want to do is go to the SEC website, Edgar, and see if they have filed a Form D, and basically it's going to say all the principles and how much money they're raising and what it's for, et cetera, et cetera. And that's all public information because they filed
mhm.
it with the SEC, and you have to make sure that it's done.
Okay.
And then from that point, then you can go to the offering documents and reading them and seeing what they say.
Mhm.
But those are two big, and you'd be surprised at how many firms wait until the third or fourth conversation. Basically, the person is ready to wire the money or write a check, and they're actually asking them about accredited status.
That could be a
So
huge
it
letdown for someone who's not accredited and doesn't know, how
correct.
that works, because they
Yeah.
they think they are ready to invest, and then they find out. that they're not accredited. Is that just because there's an awkwardness that we have around asking people financial questions about themselves? How much do you have to invest over the course of the next year? How much do you plan to invest in each deal? What's your net worth? What's your income? Are you accredited? Are you not? And we have this icky, awkward feeling around it. So do you feel like those discussions are not happening because it might turn the investor off? And so the operators are reluctant?
I think there's with people who are a little bit timid, they might feel that they don't want to upset the apple cart, so to speak. But what's interesting is that those are required questions to ask, and I think that they don't want they don't want to turn someone away that whose money they want. And this is could be fraudulent or not. It could be a completely honest operation, and they just don't want to turn somebody off the right way. This other firm never asked me that question, and I
Mhm,
invested, and they just don't want to offend anyone, and they just don't ask. Actually, investigated a firm about 6 months ago, and it was a 506B, and they had 35 accredited investors, and basically this person who had hired me was a non-accredited investor, and they
mhm.
were going to invest, I don't know, probably 60, $70,000. And it turns out that I'm like, how can you take this guy? Because you've already got 35 non-accredited investors. Oh, our lowest accredited investor invested $35,000, and we're just going to buy him out, and we're going to put this guy, we'll put him in that slot. Does that make sense? Which was legal to do, but it just seems easier to me that for operators just to deal with accredited investors. If it were me, as I look back, not that it would have made much of a difference, but I had a few non-accredited investors, and I just think it's just easier dealing with accredited investors and not
Mhm.
having to deal with all of the other extra paperwork and disclosure in dealing with non-accredited.
My attorney agrees. We were gonna do a 506B for a property. We ended up not buying it, but we were preparing our 506B paperwork, and I mentioned something about unaccredited investors, and he stopped. He says, "No, no, we're doing accredited only." I said, "We're doing a 506B so that we can have a few unaccredited investors in there." He said, "Why would you wanna do that?"
Right,
He
exactly
said it's
right.
a babysitting job and how the regulatory risk of unaccredited investors is the burden is much, much higher to allow any. So he wanted us to do a 506B that only allowed accredited investors. He says it's simpler paperwork, less reporting, and you basically you go to a couple of rich guys and they're all accredited and you don't need to advertise, and this is the easiest,
And you're
cheapest,
done.
fastest way to do it, one and done. And that really changed my thinking about allowing unaccredited investors in. So speak to the unaccredited investor who wants to invest in some private placements and they're doing the right things. They're looking for operators and reaching out to them and getting to know them so that they can get in on these offerings when they come out. Why are they a bigger regulatory risk? And why does the SEC watch out for them a little more carefully? And is this something that they should be getting into before they're accredited?
So, just to define, so accredited status means that an investor has $1 million net worth, excluding their primary residence, and that an individual has a $200,000 net income or $300,000 if they have a spouse. So and there's also an assumed level of sophistication, which honestly, I don't
The
think is
rules are
there
changing.
because,
The rules
well,
are
what's interesting is that in terms of investment fraud, more accredited investors who are really smart people who have
Mhm.
invested in a lot of different areas are ones that tend to lose more money more often. With not accredited investors, just understand what you're investing, know what you're investing in, understand the concept of if it's multifamily, if it's commercial, if it's private equity, whatever it may be, understand how the firm is going to make money. What do they have to do to make money? Are they flipping properties? Are they buying something, fixing it up, and increasing rents? What exactly are they doing and making sure that it makes sense? And understand the business side of it.
Mm.
That's probably more important than anything. Read a bunch of books. I'm not going to get into the fact that you probably should read a real estate valuation book on how to value that stuff because it gets a little bit dry. Let's just say and boring. But you really have to understand how in a general sense on the back of an envelope how you can value some of these assets, and you can
Mhm.
really make some judgments really before investing. And that's really when to do it. With hedge funds that trade in securities, it's a little bit different because the money is trading in the market. And if you really want your money back, you may pay a penalty, or there may be a, a period where you can't take the money out. But for the most part, you can get the money. Well, with real estate, it's a little bit different because 90%, 95% of that money is going toward a project, maybe more. So the money isn't there for you to take it out. So it's really much more important that you do the due diligence before handing over the check.
So let's look at the sweet spot. As you talked about, there's no real personality difference or something you could have a red flag or people asking for money too soon or not asking kinds of questions. Is there a sweet spot in the size or the type of project that is less likely to experience a fraud? So let me explain. You've got the new operator who is more likely to get into trouble because when an asset is struggling, they don't have their own capital that they can throw at it to save it. So they start looking and saying, okay, can I pull it from this project to that project? And then they get into trouble doing that. And then you have you're gonna know who I'm alluding to, the very large operators who have some very fancy firms, moving things around and having some impropriety. But because they're larger and they're respected names, people will invest because they think, "Oh, they must really know what they're doing," but are they more likely to be playing sleight of hand tricks? And so is there a sweet spot of the either the size or the type of investment that's less liable to fall into these problems?
No, not really. I've investigated whether they're investing in securities, whether in stock or futures or options or crypto, art, antique cars, multifamily real estate, commercial real estate. It doesn't matter. And really there's no asset class, especially in the alternative asset classes, that has not been used in terms of fraud. Actually, there was just a big case about 6 months ago of a registered investment advisor who was basically selling annuities that did not exist. And you think annuity, boy, that's so conservative. How did you get people to invest in that? And people are looking for safe and secure 7, 8, 9, 10% returns a
Mhm.
year for the most part. And they don't want the wild swings of crypto or futures or even necessary real estate. Any investment can be used to lure investors. It really doesn't matter.
And it seems
As a matter of fact, when I go in and look at paperwork initially, I don't even want to know, or I don't even care what the product is. I just want to see what their website looks like and what their paperwork looks like and how they're presenting themselves to the public, how they're soliciting. And then, yeah, there are certain red flags that will be apparent depending upon the product, but the product it's not real estate fraud and it's not crypto fraud. It's fraud in general, right? Or it's and most fraud are Ponzi schemes, right? And it just the product is secondary.
is there a firm size? Because there are no hard and fast rules here, obviously, but is there a firm size or type that is less likely? Because you have people who know what they're doing, they're not beginners, they know what they're doing, but they're not so big that they're starting to get really creative with the way that they're doing things. Have you found any correlation there?
The only correlation, this is a little bit difficult because there is no regulatory agency or law enforcement group that keeps track of investment fraud and Ponzi schemes. And one of the reasons, I guess, even if they did, a lot of these scams go unprosecuted because they're just not reported. People are,
Mhm.
especially high net worth people, are embarrassed because their friends and their business associates. How you didn't do your due diligence? How could you fall for that scam? There was red flags all over the place, right? They don't want to
Yeah.
have to hear that. What I can say, there is a website that's run by a securities attorney. It's called ponzitracker.com.
Mhm.
And he lists, I believe since Madoff, I believe since 2011, maybe, every year, all the Ponzi schemes that have been exposed. And I'm putting in my this book that I'm writing, I'm putting that in there to try to find some type of see what I can mine from it. And that 4 to 5 million, 4 to 6 million range, there is a lot. And then you get to that 19, 20 million range, and then the 50, and then really everything above 50. But you have a ton that are in that probably 3.5, 4 million to 6 million range, just a lot
Mhm. Oh,
in that range.
So before we left Utah, there were some billboards going up about that the state SEC was sponsoring basically fraud prevention. And it was a very clever advertising campaign. And you had the Knights of Ponzi, and they were trying to explain how these things happen so that people living in Utah could protect themselves from these frauds. And I was surprised by how many radio ads and billboards I saw going around what the SEC there was doing to educate consumers. So it makes me wonder, is this becoming easier or more common to commit these kinds of scams or frauds because of technology, or is it becoming more difficult because it's harder to hide stuff?
To make a quick point about Utah, Utah is
The
has
home
been
of the
for
scam.
well,
I hate it.
no, really it is, and it's because
Like number 2
it's
after
because of
Florida, we
the
moved from Utah to Florida, so it's like from one hotbed to the
you
other.
know, the big states, not necessarily in this order: New York, Illinois, Florida,
Yep,
Texas, California, and absolutely number 1 is Utah,
Utah.
and it's because of the Mormon Church, and there are so many scams because of affinity. Every
Mhm,
parishioner's introducing other parishioners, and you
yep,
gotta check this out. It's good to see that the SEC is spending resources in terms of educating people who live in Utah because it's a huge problem there.
mm,
In terms of investment fraud, I don't think that anything has really changed since for hundreds or thousands of years. You
yeah,
know, investment fraud is primarily based on what's called social engineering,
okay,
and it's basically convincing somebody to do something they normally wouldn't do.
okay,
And although social engineering is geared toward the IT crowd where people will try to, instead of spending weeks or months trying to figure a way to get into the back of a tech company's computer system, basically all they do is they write a script and they call the helpline, or they call an employee
mm,
number and say, hey, this is Joe Smith. I'm doing a presentation. Can you reset my password? I can't get into my PowerPoint. And they reset the password and they have access. But social engineering has been going on much longer than that.
mhm,
And redirecting questions and building trust and confidence has been going around for so long. And I think it's really no easier today necessarily than it was way back when. I mean, I guess the only thing that makes it easier is with social media, it's so much easier to take photos in front of a corporate jet, or Lisa Bentley, and make it look like you're all of that. And it's easy to go and hire somebody to shoot some video and put it into a 2 or 3 minute sizzle reel and do that kind of stuff. It's much
mhm,
easier and cheaper to have somebody go in and put a brochure on a PDF and put it on a website and all that stuff. So in terms of having all that glitz and pizzazz, I think it's much easier today than it was way back when. But in terms of hiding stuff, people are doing the same things today as they did way back when. It's the red flags haven't necessarily changed. The products have changed. In terms of crypto is like one of the big things. Crypto and actually multifamily are probably the two big ones right now. Crypto a little
mm,
bit more. And it's the red flags are the same because it's crypto versus if it was high yield notes. It doesn't make a
mhm.
difference.
Yeah, it's I
You know,
think that the more
whatever,
money the stake, the hotter the product, the hotter the market, because
right,
multifamily kinda had this little bubble, crypto, the FTX ruling shows the bubble there, that watching out for what's hot of the moment, what's becoming more mainstream, household name, like, people didn't know what crypto was. A lot of people didn't even know what it was until, what, 2020, even though it had been around for
right,
several almost a decade at that point, and so are you seeing let's go back to your earlier example of Grammarly or using AI to
sure.
pick out plagiarized documents. Does that do those kinds of tools make it easier for investigators or just average people to uncover this stuff and be like, "Ah, that's fishy. I'm gonna step back."
You know,
Or
if it here's the thing, if something's plagiarized in a big way, it makes it should raise some red flags.
mhm,
And I think and I'm writing about this actually this in my book as we speak, a big problem with investors, and it's not just investors, but we'll say investors, is that no matter what, you get that gut feeling, you see a handful of red flags, and something's not right, yet you still invest. And
mhm,
you need the ability to walk away. I'm coming up with some examples of in the sports world where, sports teams will look at certain players and they may have character issues. They may have persistent injury issues, yet they still offer them huge contracts, thinking that problem is not when they switch teams that it's going to be fine. And sometimes it is, but usually it isn't. And either they release the player early, or the player is on injured reserve for a heck of a long time. And it's that inability, it's being colored with, I guess, greed, for a lack of a better word. It's the inability to walk away. And
Mhm.
it's really hard for investors. I had one of my investors who was a friend of the family. I knew him since I was yay tall. And he would ask, or he not ask me, he would just bring this up in conversation probably every 3, 4 weeks when I would talk to him over the phone or we'd meet for lunch. Boy, I hope this isn't too good to be true. I hope this isn't a scam.
Mm.
And people realize, get a gut feeling that something's not quite right. And yet they continue to invest. And when you see red flags that are there, or something isn't right, you have to be able to walk away. You have to be able to walk
Mhm.
away. And it's very difficult for people to do.
I would say that has been my personal experience as well, because the ones that I walked away from when I got that gut feeling of I don't quite know what's going on here, and maybe it was due to my lack of sophistication, but the ones that turned out to actually be Ponzi schemes or frauds, I didn't invest in any of them. But the one that I got myself involved in was early on in my investing career, where I felt like this might be too good to be true and this guy might be a scam artist, but there was some affinity there through some introductions, and it was the highest returns that I had seen to date. I had learned that, if it seems too good to be true, might not necessarily be the best indicator, because the first time somebody offered me a hard money loan and offered me 10%, I was like, 10%? That sounds like a scam, but only to find out that's lower than even the industry standard of 12%. And so I thought,
Right.
okay, I can't really trust that unless I do some comparison shopping and find out what returns are normal for this type of investment. Is 14% normal? If it's 14%, I can know that's not too good to be true. But if it's normal 14% and somebody's offering me 18, then that's where it starts to go up. So I learned to comparison shop around a little bit. But before I wrote the check to this guy, and I ended up getting my money back, I lawyer up, and it took a while, but I ended up getting my money back. And I was always afraid that there would be some sort of a clawback if it ended up being a Ponzi scheme, because he did pay me back plus my return. And so I always felt like that return was a little bit at risk until that statute ran out, and it ended up being fine. But I felt like if I invest with him and it ends up being a scam, I didn't invest more than I felt comfortable losing. So I went into it with that gut feeling telling me there might be something wrong. And I did it anyway because I felt like I had controlled the amount that I had put in. So, can you speak to us a little bit about diversification and never investing more than you can lose? Because a friend of mine who lost almost $1 million with that Ponzi guy that we were all friends with, I asked him the same question, and he continues to invest because we know the same people, and I'll see his name on the shareholders list, when we're
Right.
signing our stuff. So he has not let this embitter him. And I asked him, I said, How are you able to continue investing?" And he said, "You know what they say, never invest more than you can lose." And I said, "You could afford to lose $800,000 and go on to not be bitter and continue to invest?" And he said it was a process that we had to go through emotionally to forgive him, to forgive ourselves, and to get the bravery to keep going. But yes, eventually we did get to that point where we overcame this huge loss and continue to invest. And now he's just diversifying a little bit better. And so that was, I'm not going to invest more than I can afford to lose. How much does diversification and that personal level of comfort and risk come into protecting investors when they're making these decisions?
I think it's huge. That huge cliche, don't put all your eggs in one basket. And a lot of times for non-accredited investors, they've only got 50,000 or 80,000 of liquid funds that they don't need to live on. But of course, if they lost it, it would dramatically change their life, at least in terms of if it's retirement funds. So let's start here. Investors, I don't want to talk any investor out of investing in a particular fund. It's alternative investments are a great way to diversify a portfolio and to make money. You just have to make sure that you're dealing with honest and credible people and that they're doing business the right way. With that said, for everyone out there, you never know if someone is going to, for some reason, lose money and will try to hide those losses until the market turns around. And it's really difficult to predict that. we just can't do it. You just never know. Every personality type has started out with great intentions, right? And every personality type has committed fraud because they were afraid to address their investors or ask for money or say that anything's wrong because it would ruin their reputation for investing in the future. So it's something that they've got to be comfortable with. In terms of losing that money, I mean, if somebody has, 50 or say 75,000 bucks and they're going to put 50 or 60 of it into, into a fund, into a real estate deal, yeah, I mean, it's tough. I can't say whether they should or they shouldn't, but I will say just do your due diligence. Make sure that the people that you're doing business with are on the up and know what you're getting into. I know people who are so risk averse that they've got $500,000 in cash sitting in the bank and they wouldn't invest $50,000 into a deal unless it was a mutual fund or an annuity or whatever. So it just depends on the person, but be prepared that if you lose it, that you may have to work longer. You may have to, come back a different way. The buy-ins on real estate funds. I mean, I've seen 10,000, I've seen 50,000, I've seen 100,000. And so they all revolve around that. But I think the biggest problem investors, especially small investors, will look at is they're chasing returns. Well, yeah, the minimum buy-in is 25,000, but I could put 50 or 60 or 70 in because it's paying 12. It says it's going to pay 12%. Invest what you can afford to lose because you just never know.
Yeah, exactly. I think that's really been what has saved me. I don't wanna diversify so much that vetting and monitoring becomes its own part-time job. So having to balance how much to put in versus the effort that I expend, vetting and watching it, versus not putting in so much that if this investment went to 0, we would be BK. And so there's a balance there for each person and the cadence and the pacing and the risk tolerance that goes in, but I agree with you. I feel like I do know a few people who've become very wealthy off of lower yield investments, but not very many. Usually they've exited a business and then gotten a big chunk, or they've had some sort of an inheritance or maybe an insurance or judgment that they've gotten a chunk of cash somehow. And then they were able to go drip that into some boring investments like, I don't know, treasuries or bonds, and able to maintain a great lifestyle because they had so much to invest that they could just put in the most boring stuff out there and still be successful. I've seen that a few times, but more often I see people who are mixing in their more conservative investments with some stuff that is higher yield and looking for the least amount of risk. So things like multifamily self-storage in the real estate industry and or businesses, the boring businesses that actually pay dividends, maybe not tech startups, but things like every neighborhood needs one type of businesses. And so
Mhm.
I see people knowing that they need to do these things in order to retire confidently, but there's still a lot of fear to do it, even though most people I know who are wealthy invest in these things all the time. They may lose a little money here and there, but for the most part, they're coming out on top. So, how has what you've learned and your experiences shaped the way that you invest and the way that you are planning your own financial future so that you can retire well or retire early if you choose to?
I would say just by taking my own advice. Yeah, I've got some money in the market, but the market's going to do what the market's going to do. And we know what it's, done this year. It had one heck of a great run now with interest rates being where they are, et cetera.
Mhm.
And sometimes actually I have another friend of mine in the business do my due diligence just so I'm not clouded. There's a real estate deal that I'm looking at as we speak, and everything looks really good. But I had him go through it, and he found a couple things which are no big deal, but I didn't find them. So
Mm,
it's by doing the due diligence that I'm supposed to do. And it's no different than anyone else. And it's easy. It's easier when you see the older 60-year-old gentleman with a sport coat and the suit on and the gray hair. It's easy to get taken up just as easy as it is when you've got the 30-year-old blonde in a skirt who is selling the investment. It's just a way to to let your guard down. And you
mhm.
just can't let your guard down for anyone or any product because anyone can commit fraud using any product. That would be my biggest advice.
I heard a story when I was in business school. It was somebody who had lost her accounting license due to embezzlement. She spent 3 years in prison, and because she couldn't work anymore, she basically did something similar to what you're doing, where she would go and speak to college students and counsel them on how to avoid committing fraud in their own businesses. And one thing that she said that really stuck with me is she said, I never thought this would happen to me. I'm a good person. I'm an honest person. I was raised in a nice family. I work hard. I did all the things and it happened to me. And she said, I think that was the biggest danger that I had because I thought it could never happen to me, made it more likely to happen to me. And so speak to some of our investors out there, whether they're passive and they're wanting to go a little bit more active, maybe sponsor their own deal, or people who are already sponsoring their own deals, the real estate entrepreneurs, to avoid letting this kind of stuff happen to us.
Okay, so I'm gonna talk about the first point you made with the lady that it never, she didn't expect that she would end up where she ended up. And I would say the same thing. I had a great resume, a finance degree, never had any issues with the law. And sometimes things just happen really fast. Literally, I'm on the trading floor. I become a member of the board of trade and I'm waiting for the computer system and phone line to be put into my trading desk on the floor. And I'm standing in front of the Dow Jones futures pit. Now I traded treasury bonds, which were a
Mhm.
little bit less volatile than stock index futures. And I'm watching the stock index futures go crazy. I'm thinking to myself, literally in a matter of a couple hours, boy, if I just changed my models a little bit to account for this extra volatility, instead of making 6.5% a year on average, I could increase that 300 basis points. I could be in the 10% range. I could be a hero. And really, with no reason at all, I basically didn't trade my first week and I redid my models, did some basic testing, and started trading. And my first week I was down 3%. And
Mm,
just that decision, that impulsiveness is how my fraud started. Actually, that was a bad business decision. How the fraud started was this. So I had a couple weeks before I had to send statements out. And I'm thinking, boy, what am I going to do? What am I going to do? How am I going to tell everybody? I'm sitting in an office, one of my friends, and I'm paging through Institutional Investor or one of those type of magazines, and I come to an advertisement for hedge fund accounting software. Now, I don't have a felonious mind, or I never thought I did. And
yeah.
the light bulb went off immediately. All I've got to do is buy this software. I could change the statements for a month or two until I make the money back and then go back to the way we were and there'll be no problems. And
Mhm.
that's how fast things change. And investors and me as a fraud investigator, that's something that we just cannot predict. I think people think that the used car salesman type of financial advisor or fund manager out there are the ones to watch out for. It's actually probably the opposite. It's the quiet ones that are more worried about what people think than
Mm,
anything else, which was my case, right? I didn't want to be thought of as a failure and didn't want all my clients to pull out. But that is something very difficult for anyone to predict, other than the fact that everyone is a potential target. So you have to investigate everybody.
yeah. Yeah. I think that having these kinds of conversations reminds me to just double check, just to make sure, not that just I'm following regulations, but that my internal compass is set. Because the mental gymnastics and justification, I think, is what's really impressive about the people who commit this kind of fraud, the stories that they tell themselves in their heads. And I watch them go from regular people to the master excuse makers and protecting ourselves from making those excuses. I think the investor is just as susceptible to it. That's like confirmation bias that if I invested
Sure.
in something or I bought something, I don't want to regret it or feel stupid or feel like I was fooled. Like you mentioned before, they don't even want to report it. They're too embarrassed to talk about it. We do the same thing as active business owners and entrepreneurs or investing entrepreneurs, where we will tell ourselves all sorts of stories and make all sorts of excuses. And so just checking in with that moral compass occasionally and saying, am I committing some of these same mental gymnastics? So what would you say are the justifications? You mentioned a few, like, I'll make it back. I'm just going to do this to to buy myself some more time so I can make it back. What are some other common excuses that you hear people saying to justify what they're doing, even maybe after they've been caught and continue to justify?
So there is in the fraud investigation world, there is a concept called the fraud triangle, and it talks
Mhm,
about pressure and rationalization and opportunity. And
mhm,
in terms of investment fraud, it probably has some value for corporate embezzlement and cases like that. But for investment fraud, it's probably a little bit less relevant
Mm.
because in terms of opportunity, if I'm a hedge fund manager and I'm asking for your money, I have opportunity because I'm at the top, right? I'm one of the principals. In terms of pressure doesn't really matter. Pressure is a spectrum, right? On one side, you have fear and greed, right? Fear being, I don't want to lose my client's money, so I'll do whatever I've got to take, right? Whatever I've got to do, I can keep face and make their money back. On the other side, you've got greed, which is I'm going to steal as much as I can. And then
Mhm.
you've got everything in the middle. You've got people who've got maybe a guy who his daughter needs chronic cancer treatment and he's
Mhm.
embezzling money for that. Does that make him any better or any worse than the person who wants to buy the new Bentley? Maybe, but the result is the same, right?
Mhm.
So in terms of pressure, yeah, it's probably good to understand them, but in terms of investigating with that in mind, it doesn't really matter. And in
Mhm.
terms of rationalization, yeah, fear is a big one. How am I going to look in front of my family and my friends? Am I going to lose my social status? If I want to raise money again, will I be able to go to these people again?
Mhm.
If I make a mistake as an officer of a company and I made a mistake, or for whatever reason, it's going to put me in a bad position. So I want to make sure I want to protect my career. But in terms of the big picture, it doesn't really matter what those are because everybody's actions, no matter what their motivations are and how they justify it or what the pressures are, their decisions and their actions are going to form red flags, right? And the red flags are going to be all over the place. And whether those red flags, whether they're because somebody wants to buy a new Bentley or because of someone like me who had every good intention to do the right thing, but I couldn't do it, right? And I ended up embezzling client money. Look at those extremes. It doesn't really matter because those two types of fraudsters, their actions lead to red flags that are there. So I always say it's so much more important to look for the red flags than to look about behavior characteristics and personality characteristics. Now, in terms of the reports, when I read a report, a lot of times the prosecuting attorneys will want me to write that so they can for sentencing they want to use as much of that negativity as they can. This person was all greed based and show how he was greedy, and I'll write that to get a longer sentence. But in terms of using that to actually investigate fraud, it really I'm not going to say it's useless, but it's not very valuable to
Okay.
to know what that is.
Are you hearing the same kinds of stories from the perpetrators that stand out as common reasons that maybe pitfalls that we can learn from so that we can avoid those same, rationalizations?
I didn't know what was a big one.
Mhm.
Is always a big one. And I'm really amazed at how often I hear it. And I probably hear it more probably when my client will, after I've done an investigation, will go in and start asking questions and will actually put some of the things that I found out there. Because I didn't know that. I wasn't told that. That's not against the law, is it? And things that you would think that the average person would know, more or less somebody who's a managing partner of an investment firm, right?
Mm.
Yeah.
Do you feel like most of the time when they're saying, "I didn't know," that it's because they didn't wanna know?
So I'm not a psychologist, and I'm sure there's probably a condition where yeah, you think for a couple seconds, yeah, this may be bad, but okay, I'm gonna put it out of my mind and just keep on going and doing what I need to do to turn it around. That may be true, but I always knew what I was doing was wrong. For the first 3 years, it was civil. Like I said, I wouldn't have gone to prison for fudging statements. There would have been a civil
Mhm.
lawsuits, and I would have lost my license. But I knew although I didn't necessarily probably know civil versus criminal, I didn't know those words. I wasn't an attorney, but I knew that from the time that I actually embezzle funds, I knew that's probably going to be prison
Criminal.
if they
Yeah.
found out,
Yeah.
if anybody ever found out.
Mhm. Yeah, it's such a compelling story, and like I said, I love the how transparent you are with it because I still feel like there's a lot of mental mumbo jumbo when people are coming away from it still saying, "I didn't know it was wrong. When I found out it was wrong, I should have stopped," this kind of justification, and so we talked about a lot of things before I started recording, and I know there are several of them that we have not touched on, so what can you share that investors really need to know that we haven't discussed yet?
Wow. You have to go in and either do the due diligence yourself, or you have to hire someone to do it, whether it's a fraud examiner, whether it's a forensic accountant, whether whoever it may be, make sure that they have experience in private investments, right?
Mhm.
And it shouldn't really matter whether it's a hedge fund or whatever it may be. And let me give you an example. You're going to love this one. And when I speak in front of accounting groups and associations and attorneys, nobody can believe this is actually true, but it is actually true. So my fraud started in February of 2003. So probably January 4th or 5th of 2004, I get a phone call from one of my clients. Hey, when are we going to get our tax stuff, our tax statements, so we could file our taxes? I never ever thought about that. I'm thinking, okay, let me call the CPA firm, the one that I made up, and find out. And I'm thinking, man, I can't make phony statements out and send them. And that's I'm trying to get out of this fraud, and I'm going to commit tax fraud. So I came up with this thing with this, and it literally within 10 minutes, when you invest in a hedge fund, you don't have to pay tax until you take the money out. And which is completely not true because it was just a US LLC and limited partnership. And
Yeah.
I can't tell you how many times I was sitting with CPAs and attorneys over the phone and in person, basically saying that. And one came really close, and is actually he was the son of a very good friend of mine. And I just don't understand how a hedge fund could, like, what kind of entity would you that you wouldn't pay tax on if it's not even an IRA. All you have to do is just call one of your colleagues who understands hedge funds. A hedge
Mhm.
fund, like a private equity fund, it's an LLC or an LP. That's all that it is. It's all pass through. It's just it's just crazy. And I forgot the point I really wanted to make. If you can about things to look for. You have to verify. You have to verify everything that people are telling you. And
Mhm.
if all of these lawyers and CPAs, they asked a lot of good questions and they went over my documents. And there was a lot of mistakes in the financials because I was just making them up. I just took the template off of the internet, right? And they missed it. And you have to make sure that you're working with someone who understands not only private investments, but also the investment product that's being used. So if it's real estate, they understand real estate. If it's crypto,
Mm.
if it's general securities, futures and futures options are and foreign exchange are big because no one understands them. And I traded futures and no one understands futures because they're completely different than how securities trade. So whoever
Mm.
you're dealing with, they have to know private investments, they have to know hedge funds, and they have to understand whatever they have to have subject matter expertise in the exact product that that you want to invest in or have invested in. That's
Oh, well,
probably the most important.
and this is something that gets me a lot of times when people are gonna invest 50, $100,000 into a deal and they don't wanna run a $29 background check. They don't wanna pay a couple $100 to an investigator to give them a little check. Is it because they don't trust? Because like you said, it was missed again and again, even by professionals, is because they don't trust the professionals are gonna get it, or because they feel like, If I lose my money, I lose my money." Like, why do you think people don't wanna pay a couple $100 or $1,000 to do better due diligence on a 50 to $100,000 investment?
I think probably the biggest reason is cost. I deal with a lot of investors who are investing $250,000 and up. And some of the documents that I'm looking at and some of the structures are really simple and aren't going to cost that much. There are some that are really intricate and complicated, and it may be five, $10,000, maybe more to go through this. And it's just very interesting that you would not want to have your house unprotected in case there's a fire without home insurance. Why would you not hire someone to go over the documents initially and every 6 months to make sure that the firm is doing what they say that they're supposed to be doing, right, with
Mhm.
investments? You're going to risk investing 250,000 or 500,000 or even $100,000 and not hire someone to do some type of work to alleviate concerns.
Mhm.
At least the top 15 or 20, which is probably going to encompass 80% of all fraud, if not maybe a little bit more. And also too, I think people maybe don't realize that they need to do it. Higher net worth individuals probably will, but newer investors probably don't want to do it. And that was
Mhm.
really my impetus to write a book that I've been working on for about 3 years. And it really should have been out a long time ago. I'm working on the name of it. But basically, it's like a do-it-yourself guide to protecting your assets. The first probably half, 2/3 is going to be about what is investment fraud. It's preventable, but if it's preventable, why do so many people fall victim? But then the second half is okay. What do you do A to Z? What are the most prevalent red flags that are out there that the individual person can look at and make a decision? And
Hmm.
then really, if you have enough red flags, or either a lot of little ones or a couple big ones, you have to have the gumption to walk away. And if you could maybe in a sentence or two kind of recap, on stuff that you've walked away from, something didn't look right financially, something didn't feel right, and you walked away. And how would you quantify that? That would be. I'd love to hear that.
The vagueness of what they were investing in was a big one. On one, I tried to sign up for their investor portal and they rejected my email. So I reached out to the person who referred me, who was a graduate of Wharton, by the way, much smarter than me, much that affinity that you're talking about.
Sure.
And I said, "Hey, I can't get the investor portal. It keeps rejecting my email." And he said, "Oh, you probably can't use a Gmail. Go and create an address over at one of these other this no-name email server that I'd never heard of before." And I was like, "Yeah, if Gmail's onto them, I think
Right.
I'm good.
Exactly.
I think I'm good." And so this was the first time I'd actually ever heard of the SEC in the context that I now understand it. It was before I ever invested in real estate or did anything. And so I looked up the guy's name and I found an interview where he was in Canada and talking about how the SEC was doing a witch hunt on him. I'm like, "Yeah, I'm done. I don't care where you
Right.
got your degree from. I'm not investing with this guy." And so that was really the first one, but there was a guy who's a used car salesman personality, and I just didn't like him.
Right.
And it turned out he went to jail for his wife too for accounting fraud, for making it look like they had investing successes that they were not actually having. Another one, again, the vagueness of what they were investing in. Oh, they buy businesses and rehab and turn around. And I didn't know much about that at the time. And for whatever reason, that one's harder for me that one's harder for me to understand why I didn't invest. I think it's just because 'cause I'm a cheapskate, and I only had $100,000, and I was just worried. I was just worried. I didn't wanna put it all in there, but the minimum was like 10,000, and so I don't know why I didn't just throw 10 grand at him. I
Right.
can't explain that one, and that one's the one that scares me because I can't really look back and figure out why I didn't invest. And then the one that I did invest in that I thought might be a Ponzi scheme, again, I was like, "I'm not gonna invest more than I can afford to lose." I had a lot more than 100,000 at that point, and so I think I put in 60K. If I'd lost it, it would have been embarrassing, but it wouldn't have been the end of the world. And his, I understood what was going on, and I understood what exactly he was doing with the money. The returns didn't seem outlandish to me. I felt like they were good, strong returns, but the thing that was giving me strange red flags, again, was his personality, and I was trying to ignore that, like what you said. It doesn't have anything to do with it, but he was just real quiet and real patient and all of that, but I don't know. I can't say what in my gut made me say I shouldn't invest with this guy. Maybe that's why I ignored it because I couldn't quite put my finger on it.
Going back to the first story where you listened to the gentleman being interviewed in Canada,
Yeah.
if he was really contrite and you know what, yeah, the SEC is investigating me and I didn't do anything wrong, and because I've given all these documents, and if anybody has any questions or whatever, they can call and ask me. If he went with that approach, would that have changed your decision to invest or not invest?
He had fled the country already at that point, so yeah,
Oh,
no, I
okay,
was done.
okay,
I'm like,
okay, I got you.
he's a
Yeah,
US citizen living in Canada, and not that they can't extradite him. I think they may have ended up, doing that at one point when it all came out, and my friend had to email everybody and apologize for suggesting this investment to us that he eventually had a net loss. No, I felt if I didn't know what the SEC was at that point, but I hear fled the country and witch hunt, and I'm like, "Nope, I'm
right.
good,
No, that's
thank
not.
you."
Yeah, that's not good. Yeah, that is just huge, and a lot of times you can't really quantify what that means, but you have to have the ability to walk
Mhm.
away. I guess probably more so now in terms of, yeah, there's probably more fraud now than there was ever before. Just as the same, there are so many ways to find deals and to network with people like yourself, Emma, who are doing deals, and there's always another deal. There's
Yes,
always somebody there. So
always another deal.
you can't be afraid to walk away. And
Mhm.
I'm so glad that you walked away from those. But people are just really afraid to walk away.
But I also think the flip side is true if people are really afraid to invest at all. And so I think it's good to reiterate that the point of having this conversation is to be empowering and to help people make more confident investing decisions, because some of us are on the side where we have an overabundance of caution and too much risk aversion, and we end up not taking opportunities that are good opportunities. And so that missing out, and then the people who have the fear of missing out, who maybe jump in a little too fast without doing their due diligence because somebody said, "Yeah, you can trust this guy." That's on the other end of the extreme. And so it's always a question of where are you on that spectrum, and where can you manage yourself, your natural tendencies to bring you a little bit more into alignment with being able to take action without being rash.
I have a client who approached me when I first started speaking. This is probably about just over 5 years ago, and I think it was a free event I did at a Rotary just outside of Chicago.
Mhm.
And he came up to me and said that he had invested in this company, and I don't want to give too many details out, but other than the fact that when I look at it and just to make sure that it was okay. And I looked at it and I really couldn't find a lot because he didn't want me to call the person. And sometimes I'll go, if I'm working with law enforcement, let me just say that sometimes I can get permission to do things that normally I couldn't do if I didn't have permission. So it can be admitted into court. And at that point, I wasn't working a lot with law enforcement. So I was really limited on what I could do. But everything, he gave me a stack of about that thick of materials and what I saw on the website and everything. It just didn't of materials and what I saw on the website. And it turned out to, and within 6 months, now I don't know if what I sent to them, if they knew about, if they were on the radar before that or not, but it was a $75 million Ponzi scheme that the guy was operating out of his house in a $75 million Ponzi scheme outside of Chicago. So in a suburb about 50 miles. Anyway, where I'm going with this, he only invested like, I think like 15 or 20 grand, and he wanted to put more money into it. But he had
Mhm.
a lot of friends and a lot of neighbors who put a lot of money into it. And he has been so risk averse. And he's let me look at probably 3 or 4 other investments since then. And one of them I was a little bit lukewarm. And I don't usually tell clients whether they should or they shouldn't, unless there's just glaring red flags. But a couple of them look really good and everything. There was like zero red flags. And he just almost paralyzed by that experience that, boy, he lost 10 grand or 15 grand. And he's lucky that he only lost that. And this guy is worth as easily is accredited many times over. And I think that paralysis does hit some people that they're just, whether they've been involved in a scam before or whether they're just so afraid to get caught up in a scam. And I have to be honest, thankfully that there's even though there's more scams taking place now, there is so many more investment opportunities out there. So there's a lot of things that a lot of investments that you can walk away from and search for something else. With
Mhm.
that said, I think that if you do the right due diligence, you're going to sleep much better at night. You have to be able to. I know I sound like a broken record, but you have to be able to go in and know who you're doing business with, and are they doing what they say they're doing? And it's
Mhm.
you have to, whether you decide to do it yourself or whether you decide to hire somebody, you have to do it. At some point, you got to take the jump. I know that I've had clients in the past where the buy-in was $100,000 and the we worked out a deal where my client, the investor, put in 25 grand the first year and then 25 grand the next year, and then the third year he put the extra 50, and they allowed him to do that.
Mhm.
Not a lot of investment companies or funds will do that, but just to thinking that if there's fraud going on, we'll find it before then. He'd be a little bit more limited in terms of loss.
Yeah.
Yeah, there's no easy answer if you're that afraid, if you're that risk averse to invest of the and just because of the market in general of whatever
Mhm.
you're investing in, or it could be because of potential fraud. It's really hard to, even with the most due diligence, stuff can still slip by. So if maybe you shouldn't invest or you should invest a lot less. But
Yeah.
I can tell you that with experience with my clients and clients of attorneys that I've worked with in the past, that by doing due diligence, it's helped them sleep much better at night. And
Yeah.
they know the exact questions to ask, and they know exactly how to find out if what they are say they're doing that they're doing. And that's really key.
Yeah, I had an experience that was the first time I'd lost money on a real estate deal. It was $5,000. I put some earnest money down on a house that I wanted to buy and from a wholesaler. And it was one of those things like your earnest money goes hard the second that it's there. And my hard money lender called me back and he said, "Hey, this your ARV is wrong and we can't lend as much as you want." And then I needed to bring more money to the table. And I just felt like I want out of this. And the title company always said, sorry, you dropped the check off, you're done. And I didn't want to call my husband and tell him. I think it was $5,000 of EMD. And I felt that fear of, "Let me give me a few hours or a couple of days to see if I can come up with an alternative solution, a creative solution where I can still buy this house or figure out something and I'll make it work." And then I'll tell him, "Hey, I almost lost money, but then I was able to." And
Right.
because of my experience with the Ponzi schemes, the words financial infidelity popped into my head. And I said, the second that I don't want to tell my husband what's going on with something where I'm going to lose money, he was very trusting with me and my business, is the second that I should call him on the phone and tell him. So I called him up and I was very upset and I said, very embarrassed, but I lost $5,000 and I am doing everything I can to figure out a solution to get it back. But I just needed to let you know that's what I'm going to be working on over the next couple of days. And he just very quietly, he said, "I'm sorry that happened. I know that this was really difficult for you," he said, "but I know that you can make it back." And I think that because it was only $5,000, I knew that I could make it back too. And I think that is really what I've carried with me into this journey is that if I believe that I can make it back, then I feel safe investing it because that comes from the spirit of abundance rather than the fear with scarcity. If I feel like, hey, I can recover from this and I am confident that I can make it back, I'll go ahead and I'll place some capital. Not if I have that bad gut feeling, I just walk away from that. But if I feel like these are good people and I'm not getting any red flags, but I still feel like something could go wrong, even if it's not fraud, things go wrong. I
Right.
work with that mindset. Can I make this back? And the older I get, the smaller that number gets.
Right.
But it's the
Right.
same question.
I've got stories of I've interviewed a lot of clients from a lot of investors from a lot of different Ponzi schemes, and sometimes people, and especially seniors, where they don't have a lot of options in terms of making money back. But going to the blue collar guys, whether a truck driver, a construction guy, they'll go and work second jobs, and their wife will go to work, and they didn't necessarily want to do it, but they're going to do what they've got to do to get back whole, so they can invest again somewhere and be a lot
Mhm.
more careful. You know what I
Yep.
mean? So
Yep.
it's seniors is the hardest thing to see. And I thank God I did not have any grandmothers or grandfathers in my scheme
Mm,
who lost everything. And
good.
I just not that it makes it any better, but I just feel better myself that didn't
Yeah.
transpire. But I
I
but I
bet
I can't say I'm sorry. Go ahead.
Oh, I bet you've had a lot of conversations with yourself about that kind of stuff. If there was a senior in there, would I have still taken the money? I don't know. Those self-examinations I think can be really valuable.
Yeah, and sometimes you don't like the answers that you come up with.
Yep. Yep.
I'm just glad that I was never put in that situation. A lot of I've had a lot of conversations with victims, a good handful of my clients, my ex-clients, and Madoff investors and et cetera. And it's funny that the takeaway is that the idea or that in terms of what they would have done different, they like the idea of the investment. They just wish they would have looked into it further, or they would have taken their that gut feeling that something's not right, and they would have expanded upon that, and not they just would have walked away. Yes, the idea was great, but we should have made sure that it was what we thought it was,
Yes. Yeah.
not with what they wanted us to believe.
Not what we hoped it was. Yeah. So, man,
Exactly correct.
I I could keep going. There's so much here. Maybe we'll have to do a revisit in a couple of
Sure,
months and find out once your book is published, do a little what do you call it? A book launch
absolutely.
tour. So in the meantime, how can people get a hold of you and learn more about the services that you offer to help people investigate or like you said, even some DIY resources for people who don't want to spend $29 on a book or a background check?
Sure. So my website is theinvestmentfraudguy.com. And if you want to contact me with any questions, I'd be happy to look at any materials for no charge. Just as the kindness of my heart, you can email me at jb@theinvestmentfraudguy.com, and I'd be happy to answer any of your questions or comments.
Mhm, yeah. Take him up on that too. I know a lot of times when I'm listening to a podcast, somebody will say, "Oh, we'll do a 15-minute free phone call or something like that." And I feel like, "Oh, no, I don't wanna bother him, right? Because there's a service there. But take him up on that, because this is how you form relationships with people and you find people that you want to work with is take the free offer, take the free stuff. And if there's something that resonates there, a personality that click, or a service that you really need, you want to build that relationship so that you can go into this doing business with somebody that you trust to be doing a good job. So don't feel obligated, but don't feel afraid to jump on and take advantage of that. This is why we do the podcast, is because I want to introduce you, the listener, to people who can help you on your investing journey, who can empower you to make good decisions so that you can go after those dreams that we all have of having more control over our money and therefore having more control over our time and our lives. And so thanks so much, James, for coming and for educating us. Like I said, let's do it again in a few months when your book is out. Let me know, and we'll get everybody updated on some of the latest changes that the regulatory agencies are making and how we can just be better investors and better investor operators.
Absolutely, Emma. Thank you.
Thank you so much. Appreciate it. It's easy to see why James is such a popular author and speaker in this space, because he knows his topic inside and out, not just from his personal experience, but from all his years since now of advising law enforcement and investigators on how to spot fraud so that they can help people protect themselves from it. So he's making a little bit of a pivot recently. Instead of spending so much time with, say, law enforcement or accountants teaching them how to spot this, he really wants to get in front of investors like you and me to help us protect our own assets from these types of situations. So he's writing a book about how we can learn to protect ourselves and where to turn to when we need some professional help. So please reach out to James and let him know if you're considering looking at something. Again, like I said in the interview, take him up on his offer of that free call, because building those relationships is really what makes this whole investing world go around. It's important to really trust the people that we're working with, and knowing the right questions to ask, knowing the right things to look for will help to increase your level of trust rather than increase your level of fear. So we'd love to have you check us out, do all your due diligence, and make sure if we are the honest people that we portray ourselves to be, and see if you want to come and join in with us on your passive income adventure of retiring early so that you can have more control over the way that you live your life. We have a free weekly club where we meet and just look at deals. You can get more information about that at riseclubcapital.com, or check out partnerwithrise.com if you'd like to grab some time on our calendar to talk about how you can invest with us for more passive income and financial freedom. Thanks for joining us, and until next time.